All right, Anand Radhakrishnan joins us. Let's take our conversation forward. Managing Director with Sundaram Mutual Funds. Anand, good morning. Thank you for joining us.
Good
Uh,
morning.
how are things?
Things are good. The year is ending with overall with the positive gains in all cap segments of the market. Most of the funds have delivered outperformance versus the benchmarks. So I would say while we are still off the peaks of the market, we still are ending in a good note.
Uh, the Nifty this year, despite the fact that large cap stocks were called as a store of the value at the beginning of the year, is up 8%. Small and mid cap stocks are up in their late teens or early 20s. Uh, at the beginning of the year, the general sense for small and mid cap stocks will underperform, large cap stocks will come back. But the reverse has happened.
Exactly. I think even I also held the view at the beginning of 2024 that valuations are more accommodative in the large caps and mid and small caps will have some relative underperformance versus large caps. But like many times it happens, market proves us wrong, and this was one such year. There are multiple reasons why I think this has happened. One, of course, is the breadth of earnings have been pretty healthy. So market participants have been able to find newer ideas across multiple sectors, and many of them in the mid and small cap segments, which have been able to participate in the overall economic growth environment. I think that is one. Even as we speak, this trend is continuing, where we are seeing a very broad participation of companies in earnings growth trajectory, and that gives a very healthy environment for people to take risk. So both funds as well as individual investors have kind of been not afraid to take more risks during the course of the year, and has given them some kind of a confidence. That earnings trajectory has given some kind of a confidence that even if they are temporarily wrong over a period of time, their investments are going to get better returns. I think that has been the single biggest reason for the mid and small caps delivering better returns than large cap. Second reason, of course, is large cap earnings were pulled down by specific sectors which are only large cap, like oil and gas is a large cap sector, and which significantly had lesser earnings than the previous year. So optically, it makes it look that they had lesser earnings growth, but there are no mid cap or small cap oil and gas companies. So to that extent, I think the numbers are a little bit of a mathematical adjustment.
Debate on where the economy is headed. Now, the slowdown in last two quarters has come as a bit of a surprise. Do you think the economic growth and earnings downgrade is a real deal, and we could see it for a prolonged period of time?
One thing that I understand from what happened over the last 2 quarters, the slowdown that we are seeing either in the banking sector or NBFC sector or even consumption sector, is a bit of an engineered slowdown, wherein we have seen RBI tightening continuously or on the lending norms, on the unsecured lending, personal loans, etc., where they were possibly worried about an emergence of a micro bubble or sorts. And similarly, we have also seen the emergence of similar stress points in the microfinance institutional space, etc. Some of this has kind of led to, I would say, a cyclical kind of a downtrend in the consumption space, and that is already reflecting in the performance of the companies in that space. Going ahead, I think, of course, this is also having a overall pull down impact on the economic growth. So this voluntary, cautious application of brakes by the policymakers have led to some slowdown. Now we have to figure out as to whether we let it become even worse before we act, or kind of start loosening the policies and the tightening bias that we have had in the coming quarters. I would say that policymakers should err on the side of caution and say that, and caution of facing a significant slowdown, and therefore should start to make remedial steps going forward. The sooner they do it, the better it is.
Everybody in a sense has been quite excited about what private banks have to offer in terms of deep value. But private banks are a function of economy. Economy does well, banks will do well. But if economy is not doing well, why would banks do well?
First, economy is doing well. It's not doing that badly.
It has become 6, earnings upgrade. See, earnings growth are lower. All I'm saying is that I'm putting, you compare India with the world, okay, 6% is great, right? I accept that. But what the assumptions of 2024 and 25 and 26 were on that account, there is a slowdown which has hit us. And I mean, government spending bolo, inflation bolo, whatever may be the reason, you are in a corner right now.
Yeah, one thing is that, we are having a slowdown versus the cyclical peaks of growth that we have had post the COVID pump priming of the economy. Most governments prime the economy, India also primed the economy. And to that extent, we are having as the pump priming effect wanes off, as year on year, the fiscal impulse, which the government was additionally giving, is taken back, we will see a pullback of growth, and which is pretty normal. So we might actually bit of undershoot and eventually come back to the trajectory of earnings. So I would say that overall economic growth, what we are seeing is more cyclical slowdown than anything structural to it. Second is with respect to the bank's question that you asked. The key litmus test I would apply is, are private banks losing market share or gaining market share in the overall banking system? The main metric that we use is the deposit market share, because liability franchise is tougher to create and more stickier, and is a good indication of a financial company's longer term strength. And even during this period of underperformance over the last 18 months, when I look at quarter on quarter, the deposit market share of private banks versus the overall system, we have seen only improvement, not deterioration, which means the underlying fundamental trends of the banking sector is actually strengthening the hands of private banks. But there are other overlapping issues like over ownership, the near-term pressure on margins, pressure on RBI to cap the high-yielding unsecured personal loan where private banks excel a lot. All that has led to a near-term sentiment weakness, and maybe to some extent earnings weakness also. And we should not get overawed by that matter. I think we have some very good banks available at moderate valuations in the private space. It's only a question of time before they start delivering better numbers and markets start to appreciate that. Maybe 2025 may be a year of that, I hope, and let us see.
There is a lot which hinges on this FI activity in India. Even though domestic flows have been strong, net markets still want to understand that which way the FI and the global liquidity would move. How do you see global liquidity moving in 2025 in the light of Donald Trump taking over as the next US president, Fed being reluctant in terms of rate cut, and how much importance would you give to FI liquidity into India for 2025?
Now, keeping aside the political overtones of a new regime in US, if you broadly look at it, we have been in a global softer rates, growth revival kind of an environment where central banks are trying, after fighting inflation, they are now slowly moving towards stoking growth, whether it is US, Europe, or parts of Asia. Now, if that trend is the primary trend, if you can recognize that as a primary trend, my guess is that foreign investors may have more cyclically growth-oriented stocks picked up in other markets than India, which is a reality, because India did very well during the slowdown phase, and therefore they have made money and relatively, etc. So elsewhere, many companies may come out of more sluggish earnings growth and may go towards a better growth, and that makes it, and they may be available at more moderate valuations. So in a sense, I would say there are better cyclical growth bets available in other markets versus India, and that is one of the reason foreigners may be juggling around money from taking money from emerging markets and putting in some of the developed markets. I would say in 2025, at least in the early half of 2025, this trend may continue despite any counter narratives that can emerge from the policymakers in the Western world. Maybe there are tariff barriers, maybe their interest rates don't get cut as much as we expect. Maybe the growth doesn't revive as fiercely as one would bet on, etc. But these are, I would say, counter theses. The primary thesis remains that of revival of growth globally. In that context, the relative growth difference between India and other markets may shrink, and therefore the relative attractiveness may also be a little bit of a question. That is point one. Point two is, India continues to be a lone star amongst the many emerging markets by the virtue of its well-balanced economic situation, earnings growth, market performance, etc. I don't think, therefore, I think in the minds of portfolio investors, especially the foreign ones, India is still a darling. India is still a great pocket of the healthiness of the portfolio. And on other parts of portfolio, I'm sure they are struggling to kind of maneuver. So to that extent, valuations alone may not be the reason why foreign investors will not be looking at India. They look at India in a more holistic space and its fitment to a longer term strategic portfolio. So to that extent, I don't think they will turn as en masse negative kind of a thing. Yeah, sure, they will take some tactical bets here and there and move their marginal money out of India to other markets. Third point is how important they are. Yes, as a block of existing investors, they are very important. Yes, as a flow, on the flow of incremental basis, the relative importance has come down over the last few years because of domestic flows being robust. In the current calendar year itself, we have seen significantly much. Foreign investors year to date net flow is only about $650 million or $700 million or thereabouts, whereas the Indian investors have poured in tens of billions of dollars into the market, which kind of shows at the margin, the domestic investors are firmly now in control of the market, and that may remain so unless the narrative changes differently.
Yeah. Anna, just wanted to get in. I mean, I know you're talking about India being the darling and a lot of things working in our favor, but if there were to be a niggling worry, it would definitely be with what has happened within the consumption sector. And I think that has been reflected in the quarter gone by. Is that a worry that's going to only escalate in the next year?
I have a little bit of a contrarian view. A couple of things that have impacted consumption. One is, of course, the broader consumption trend slowing down. And second, they have had the margin pressures across board. I mean, whether it is a detergent company or a paint company or some other company, etc. We have had combination of both pulling down on overall margins. And maybe going ahead also, we may have crude palm oil prices are high, and that may have some impact on margins, etc. But that's the reason why many of the stocks are trading at 52-week lows, if not 104 weeks low. And many of them have shaken off their frothy valuations and have come to a more moderate situation. So that is one. Second is going ahead, I think, while the basket of consumption has evolved over time and the new growth sectors in consumption has come, as long as we are aware of that, I think there is still reasonable investment bets that can be made. Maybe it is instead of certain kind of old consumer staples, to certain discretionary consumption or new kind of consumer staples one can bet on and try to make money. Now, third, of course, thing is this nagging worry that the middle class is not having enough disposable income, or maybe their income is not growing at a level which can support more and more consumption at that kind of a thing. I think it's a lot of thing is a little bit of overblown worries, but while in the short term we may have seen that trend, I think maybe because of the job creation in the IT sector is low and few other sectors, we are able to see significant recruitment trends. But we think at the margin, things are changing for better, both on the urban side as well as on the rural side. And maybe in the second half of 2025, we will see consumption come back, and one can possibly look to find some good investment bets in that space.
Okay, so that's the take coming in as far as the market setup and the mood is concerned. Thanks so much for making time and speaking with us today. Really appreciate you joining us on the show right now.
If you like this video, then like, share and subscribe to ET Now.